And week to week, we talk about money. And, you know, it's not, you work hard for it, and I feel that you really don't want to give away money to the tax man if you can avoid it legally. And we're very fortunate because we have Darren Farwell and the Farwell Group that are stewards of the personal wealth for their clients, who educate us here and let us know that there are options and choices that can affect how much money we keep, and so that we can invest tax effectively. Last Saturday, Leslie McCormick stood in, and basically she explained that. And if you want to hear that on our last show, as I said, you can just go to marylands.ca and log on to the archived show. But this morning, we're privileged to have Darren Farwell of the Farwell Group with us. And good morning, Darren.
Good morning, Marilyn.
So happy story today?
Well, given what happened with the Leafs the other night and the poor weather we are having today, I really reached deep to find a happy story. I think we need one here in Toronto. I have a happy story about a business owner who was able to save or plan on saving a significant amount in taxes. Our business owner, Carolyn, came to meet with me because I was helping a business owner friend of hers deal with the new tax rules regarding passive income earned inside a private corporation. We have significantly reduced the taxes she's likely to pay in 2019 using return of capital managed funds. But let's start with what's this new tax rule that's causing such a stir. Starting in 2019, the small business deduction limit will be reduced by $5 for every $1 of investment income above the $50,000 threshold. That is equivalent to $1 million in passive investment assets at a 5% return. Now that's a big deal, and big with the capital B-I-G, because the small business tax rate is roughly, I'm going to use round numbers, I'm not an accountant, is roughly 15%. So for every dollar of net earnings your company makes, the government takes 15 cents and you keep 85. Whereas the regular corporate tax rate is more than double that, such that a business owner would only keep 60 cents on the dollar instead of 80. So when you think about that in terms of a company making $500,000, that means at a corporate rate, you'd be paying $300,000 in tax, whereas the small business rate paying only $75,000. So it's a significant difference. And with that much money at stake, understanding what you can do to minimize the impact of the new rules around passive investment income inside your private corporation is critical. Now, before we get into the full story of Carolyn and her situation, let's talk about who doesn't need to worry about the new passive income rules. Which business owners will not be affected, and frankly, there's a great many business who will not be impacted at all. Remember, you lose small business deduction limits only for passive amounts of investment income that exceeds $50,000 inside your private corporation. Remember also, as I said, I am not an accountant. I can only suggest ideas and strategies based on broad principles and general knowledge. Nothing I'm suggested should be construed as accounting advice. Everything should be confirmed with your own accountant based on your own specific personal circumstances. Okay, that's my fine print disclaimer.
Caution.
Which business owners do not need to worry about the new passive income rules, generally speaking? Well, farmers saving inside their corporation through programs such as the Agra Invest, that wouldn't impact passive income rules. Business owners that use the retained earnings of their corporation to take an ownership stake in active businesses, like promising startups. That's often called angel investing. For example, if a business owner were to invest $20,000 in a high-tech fintech company using blockchain, and that $20,000 investment turned into $100,000, that would not be considered passive income, and so wouldn't be subject to these rules. Business owners whose investment income is less than $50,000. For example, one of my clients owns a hotel, and has accumulated $400,000 in savings. However, because the business is very cyclical, he feels he has to keep his savings in low-risk bonds. Particularly in today's world, low risk means low returns. So as a result of having these savings in very low return investments, the total return is not exceeding $50,000, so he will not have to worry about the passive investment rules. A business owner who owns, for example, a retail store generally has to keep cash deposits to pay suppliers and the salaries of their employees. While the owner does earn interest income on these deposits, the deposits are considered incidental to the business, and thus the income is not considered passive income, and therefore the rules wouldn't apply. Carolyn's case, however, is different. Carolyn owns a very profitable private corporation that earns more than $500,000 a year. She has a significant portfolio in her company, which she intends to pass on to her children. Given Carolyn's level of savings and level of income, she is at risk of losing the benefit of the small business tax credit starting in 2019. All of her income will be taxed at the general corporate rate, unless. Working with Carolyn's accountant, we reconstituted the type of investment she holds, so we reduced her taxable earnings significantly. By using return of capital managed funds in her private corporation, instead of a mix of interest income and dividends, we reduced her forecast passive income in 2019 well below $50,000. In fact, she's going to end up saving, based on our forecast for 2019, $52,000 in taxes.
Shall I applaud now?
She was applauding. So that was equated to about 10.7% less than she would have paid under the upcoming changes. So Carolyn hadn't heard about using return of capital managed funds in her corporation, but by finding out, she saved potentially $52,000 in 2019. As we so often say, Marilyn, you don't know what you don't know, but I do know that Carolyn is quite happy about paying less in taxes.
Well, that's a happy story, and it's a good incentive for people to have their financial plan reviewed and put in place, because things have changed. The tax laws have changed. The implications have changed. So what worked doesn't necessarily work now. I suggest that you, Darren can't be financial planner for everyone. So if you have a business and you're looking at taxes and you're looking at what you're investing, definitely make sure that your planner is current and up to date. And I think that Darren volunteers a complimentary consultation, because my team does. And if someone wants to talk to you about these return of capital managed funds and the new tax rules, are you going to work today?
Yes, it looks like a cool rainy day. I'll go and spend the morning in the office.
And most people are going to stay home because I guess there's going to be an ice storm. So the phone number to reach you today, Darren?
416-863-7501.
416-863-7501. Be proactive. Take charge of your finances in your life. Ask questions of experts and then make informed decisions. And when it comes to money and investing for your retirement, I don't think there's anyone better than Darren Farwell. You've impressed me for so many years, Darren, and you always come up with current information that really makes me reboot my mind and think about financing in a different way. So thanks for coming, and I look forward to learning more next week.
You're welcome, Marilyn.